Aramark, ticker ARMK, unequivocally beat Q3 fiscal 2026 consensus across the board. Revenue came in at $5.058 billion, beating forecasts of $4.92 billion, which is an increase of 9.3% year over year. Adjusted EPS hit 22.10 cents,
beating the $1.48 estimate by over 8%.
Right, and representing a 29% jump on a constant currency basis. GAAP EPS was 0.36 cents, which is up 34%.
And the forward guidance is what really sealed it.
Yeah, management raised their full-year fiscal 2026 organic revenue growth outlook to 9% to 10%, up from the previous 7% and 9%. They reaffirmed adjusted operating income growth of 12% to 17%, EPS growth of 20% to 25%, and a leverage ratio under 3.0x.
Which the market obviously loved.
Oh, loved it. The stock surged post-report. It climbed 8.22% pre-market and closed up 8.54% at $60.47, hitting all-time highs and surpassing its previous 52-week high of $58.68. Okay, let's unpack this. Our mission for you on this deep dive is to break down exactly how Aramark achieved these numbers, evaluate the underlying financials, and, well, figure out what's driving this rally.
Yeah, it's just a phenomenal quarter to pull apart because, when a company with a market cap approaching $15 billion, operating in what most consider a very traditional, slow and steady sector, suddenly prints numbers like this,
right,
and revises guidance upward, you really have to look under the hood. It's not just a post-pandemic recovery story anymore. This is structural growth.
For sure. But before we get into the operations, there's actually a technical accounting nuance buried in the fine print that makes that 9.3% revenue beat even more impressive.
Oh, the 53rd week calendar shift? Yeah, I saw that.
Exactly. It's one of those quirks of corporate accounting that can really trip up retail investors building out their own financial models.
Definitely. So a standard year is 52 weeks. But since the calendar doesn't divide perfectly into quarters every few years, companies have to add a 53rd week to realign their fiscal calendar.
Right, and fiscal year 2025 had that extra 53rd week.
Exactly. So because Q3 of fiscal 2025 had an extra week of sales baked into it, the year-over-year comparisons for this current quarter, Q3 2026, are technically skewed downward.
Because you're comparing a normal quarter this year against a slightly longer quarter last year.
Right. Management specifically noted that if you strip out that calendar shift and compare apples to apples, Q3 revenue growth would have actually been around 11%.
Wow. Wait, really? 11%?
Yeah. And their operating income growth, which reported at 18%, would have been closer to 29% without the calendar shift.
That is wild. I mean, that really contextualizes why the stock jumped nearly 9%. The headline numbers were a beat, but the underlying momentum is drastically stronger than a casual glance at the press release suggests.
Yeah, it paints a picture of a company operating with incredibly high visibility and strong pricing power right now.
Which brings us to how they actually generated that $5.06 billion. We need to transition from the raw numbers to the operational execution.
Right, looking at volume, retention, segment performance.
Exactly. And the first thing that jumps off the page is the client retention rate. They posted an industry-leading record client retention rate of roughly 98%.
That's huge, because in the food and facility services industry, switching costs are notoriously low.
Right. If a university or a corporate campus isn't happy with the cafeteria food or the janitorial services, they just put out a new request for proposal.
Exactly. So hitting 98% retention means their base business is an absolute fortress. You don't have to constantly fill a leaky bucket.
And because the bucket isn't leaking, all the new water poured in actually raises the overall water level. Yeah. And they poured in a monumental amount.
Yeah, year-to-date new business wins totaled over $1.6 billion. That is a massive 51% increase year over year.
Which is just staggering. And when we look at where that growth is coming from, geographically and by sector, it's incredibly broad-based.
Yeah, in the U.S., growth was heavily led by the sports, leisure, and corrections segment.
They called out higher per capita spending and massive attendance tailwinds from things like the FIFA World Cup matches and the NBA and NHL playoffs.
Right. It goes beyond just getting bodies into seats, though. Consumers are shifting toward premiumization at live events.
Oh, for sure. You're not just buying a standard hot dog and a generic light beer anymore. Fans are buying, $18 local craft IPAs, gourmet brisket nachos.
And Aramark is capturing the upside of that discretionary spending shift. But it wasn't just stadiums driving this. The business and industry segment sustained double-digit growth, too.
Even with hybrid works.
Yeah, even with hybrid work schedules. Corporate catering and facility management are highly relevant right now as companies try to lure employees back to the office with high-end dining perks.
That makes sense.
And the international segment was a powerhouse on its own, growing 11% organically to $1.5 billion.
Okay, but winning all these massive contracts is great for revenue. But usually when a legacy services company grows this fast in this kind of macroeconomic environment,
With inflation and everything.
right, with food and labor costs being such known pressure points, their margins usually get completely crushed by labor shortages. But operating income here increased 18% to $216 million.
And adjusted operating income was up 13%. Both reported and adjusted margins expanded.
So how did a legacy services company expand margins? Is this like a restaurant managing to squeeze more juice from the exact same oranges without cutting the quality of the juice?
That's a great way to look at it. The mechanism driving that margin expansion comes down to broad-based new business volume and aggressive supply chain management.
Okay, so leveraging fixed costs more effectively.
Exactly. The why here is how they manage fixed versus variable costs. When Aramark lands that $1.6 billion in new business, they do have to hire more frontline workers and buy more food, which are variable costs.
Right.
But they do not need to scale their corporate overhead, their HR departments, executive teams, core software platforms at that same rate.
So they're spreading those fixed corporate costs over a much larger revenue base.
Exactly. And their supply chain negotiating power is massive. When you are buying ingredients for thousands of locations globally, adding 100 new massive locations gives you even more leverage over your suppliers.
You squeeze more juice from the orange because your bulk purchasing power allowed you to buy that orange at a steeper discount in the first place.
Precisely. And management specifically noted supply chain efficiencies and productivity gains as the core drivers for this margin expansion.
Okay, that makes complete sense for the core business. Selling premium stadium food at higher margins, leveraging bulk discounts, all that's a very solid growth story.
It really is.
But here's where it gets really interesting. Strong stadium hot dog sales and business catering are great, but they don't typically cause a mega cap stock to jump nearly 9% and raise full-year guidance.
No, they definitely don't.
We have to talk about the hidden catalyst driving this future outlook, and that's artificial intelligence infrastructure.
Yes. The Aramark Nexus platform. For anyone trying to model out the next 5 years of this company's growth, this is arguably the most critical piece of the entire earnings report.
I have to push back on this premise, though. What does a food service company have to do with AI data centers? This sounds like selling premium pickaxes and catering to the miners during the AI gold rush, rather than trying to dig for gold yourself.
What's fascinating here is that your pickaxe analogy is the perfect framework, but you have to scale it up to a massive industrial level.
Okay, how massive?
Building and running a modern AI data center for a top global hyperscaler. You know, the mega cloud providers like Amazon, Google, Microsoft is an astronomical undertaking. We aren't talking about a server closet. We are talking about colossal facilities often built in relatively remote areas where vast tracts of land and gigawatts of power are cheap and readily available.
So you are essentially building a town in the middle of nowhere.
That is exactly what it is, a pop-up city. And building and running those remote facilities requires thousands of civil engineers, electricians, construction workers.
Right, and those workers need a place to sleep. They need to be fed 3 high-quality meals a day, laundry services, daily cleaning, wastewater management.
24/7 security, all of it. And the hyperscalers want to focus entirely on AI. They want to focus 100% of their capital and brain power on securing GPUs and training models.
Right, they don't want to run a remote hotel for 3,000 construction workers in rural Texas.
Exactly. The human infrastructure is a distraction, so they completely outsource the management of these workforce communities to Aramark. And Aramark is seeing momentum scaling way faster than expected here.
Yeah, according to the report, Aramark just launched operations at its first Texas-based AI data center site with a top global hyperscaler.
They didn't name drop the client, but the market has a pretty good idea.
Right. And they are already mobilizing a second location and just signed a multi-year engagement with a leading AI data center colocation provider to serve these exact types of workforce communities.
The revenue projections attached to these specific wins are staggering. Just 3 lead sites in this Nexus division are projected to generate $400 million to $500 million in annualized revenue by fiscal year 2027 to 2028.
$500 million in recurring annualized revenue from just 3 sites.
Yeah. It proves that the addressable market for their core hospitality services is rapidly expanding into high-growth tech infrastructure.
So what does this all mean? The growth story is solid, and the AI tailwind is exciting, but retail investors need to look at the balance sheet to see if the financial foundation can actually support this expansion without undue risk. Let's talk valuations.
If we connect this to the bigger picture, the market's aggressive reaction to the earnings makes sense, but it also prices in a monumental amount of future expectations. Following this rally, Aramark is currently trading at a PE ratio of around 41.75x.
Wow, which is dangerously high for a legacy services company. The industry average usually hovers around 25x.
Exactly. A multiple of nearly 42 means investors are paying a massive premium for every dollar of earnings Aramark generates today. They are paying that premium directly because of the Aramark Nexus AI news.
They see Aramark as a backdoor AI infrastructure play.
Right. They see that $500 million revenue projection from just 3 initial sites, and they are pressing in the assumption that Aramark will inevitably win site 4, 5, 10, and 20.
Which brings up a major execution risk that we have to talk about. The stock is essentially priced for perfection right now.
Yeah.
Aramark has to flawlessly execute these massive record-level client mobilizations.
And that takes immense upfront capital and operational bandwidth before the revenue really starts flowing.
If they fumble the execution on these new hyperscaler contracts, that premium valuation could correct sharply.
It absolutely could. Plus, there is also a seasonal cash flow dependency in their traditional business.
Right. Their education and sports segments generate cash unevenly throughout the year based on school semesters and sports seasons. So they have to manage that fluctuating cash flow while funding these huge data center build-outs.
Which is why the balance sheet health is so critical right now.
Right. So if they're mobilizing all these massive new sites, are they drowning in debt to finance it?
Actually, no. The balance sheet is strengthening. Their net debt to covenant-adjusted EBITDA ratio improved to 3.5x in the third quarter, down from 4.0x previously.
Okay, dropping that ratio means they are getting financially healthier. And management expects that leverage to drop below 3.0x by the fiscal year end, right?
Yes, which is a very healthy trajectory for a company in a capital-intensive service sector actively expanding into new verticals.
And how does their actual liquidity look while they pay down this debt?
Very strong. They had over $1.4 billion in cash availability at the quarter end. The company generated a positive $42 million in free cash flow in Q3.
I also saw they proactively repaid $100 million of their 2028 term loans right after the quarter ended.
Yeah, reducing future interest expense. And they declared their standard quarterly dividend of $8.12 per share, which is a dividend yield hovering around 0.77% to 0.83%.
Not a massive income play, but it shows a commitment to capital return consistency alongside their debt reduction.
Exactly. When you synthesize an 11% normalized organic growth rate, strategic margin expansion, proactive debt reduction, and $1.4 billion in liquidity, you get a very compelling financial profile.
Even before you factor in the AI data center narrative acting as a massive growth multiplier, it really is a fascinating strategic pivot for a company most people associate exclusively with stadium hot dogs and college dining halls.
This raises an important question for you as you evaluate the broader market shifts happening right now. Aramark's surprise success with data centers proves that the AI boom isn't just enriching chip makers and software developers.
Right.
It challenges you to look at your own portfolio and ask, who else in the traditional boring sectors like commercial HVAC, industrial catering, or commercial real estate is quietly positioning themselves to profit off the massive physical footprint required by the AI revolution?
That is an incredibly important strategic question to take away as you hunt for value outside the massive tech valuations. Make sure you follow the show for daily earnings coverage to stay on top of the numbers moving the markets.